Hey everyone, and welcome back to another video for today. So in today's video, we do have quite a lot to go through. We have Duolingo that reported their quarterly figures, and unfortunately the stock is down. Well, it says here 18.2%, but in reality it's already down 21%. So we're going to go over all of the numbers for Duolingo. There are also, of course, reasons why. Stock market nerd here give us one good reason. Then Elf also reported. We have DoorDash, we have Fortinet, Figma, Snap is actually up, right? Snap usually moves during earnings. The question is, does it move up or down? In this case, it moves on the way up. Then we've got ARM and also Qualcomm. I do know that some other companies reported as well, like Robinhood, but I'm pretty sure that Amit and Roy and Tanner got that one covered. Tomorrow, we do have Oscar and Shift4, and I do think DraftKings after hours. Shift4 and Oscar is in the morning, I do believe so. I'm not sure if I'll be able to do a live stream because I do have a train to catch. So I'll just do maybe a quick recap video before the market opens for Oscar and Shift4. So stay tuned for that. If not, it's just going to be in the evening. And so without further ado, let's go over everything you need to know in this video. Yes, unfortunately, I do own a Duolingo. And yes, maybe in hindsight, I should have taken some profits when I was break even, but it is what it is. I'll explain everything throughout this video. Hit all the buttons, and if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/coachinvestor. Thank you very much. So Duolingo has already experienced a huge drawdown, especially recently, right? They are now down 62% from the highs back in May. I'll be the last person to say that, oh, it makes no sense. No, it made sense because it was very expensive back then. It's not the cheapest one right now either, but it's not the most expensive one. It's a company that's still expected to grow quite a lot, top and bottom line, super high margins. It is, all in all, a great business. My mistake is something that I've admitted before, not just because we're down now even more, but if you go back to the other videos, I admitted that I went into Duolingo too aggressively at first. I went in because it was a good business, but I should have gone into it and grew my position like I'm doing with a Shift4 and a Rubrik, slowly but surely accumulating more shares. I was just caught by the moment, so I admit that was a mistake. I was wrong. I am right that this is still a good business so far, right? So far, as I've said before, the moment that they'll show me that this is turning into a bad business, I'll of course sell all my shares and admit this was just not a good investment. Right now, it is not a good investment because my shares, I'm down on my position. But I'm down on my position just because my timing wasn't right. The numbers were still quite good. Right? The numbers were still quite good. If we go and look at this quarter, for example, right? Look at this. Daily active users have gone up. This is this number right here. Now over 50 million daily active users. That continues to go up. Remember last quarter, monthly active users went down a little bit after a very strong first quarter. But as they've explained, their job is to make sure that you come back each and every day. And so daily active users made a lot more sense to follow here. But okay, fine. This quarter, we've got both of these metrics that are going up. Then, if we look let's go to the transcript. Let's look at the slides for Duolingo. We can see the following thing. Revenue increasing 41% year over year. Total bookings up 33% year over year. Net income, $292 million, significantly higher than the previous year, but that's because they benefit from a one-time tax benefit. So that, of course, inflates that number. Paid subscribers up 34% year over year to $11.5 million. And so the key takeaways for them is this, by the way, they show us right here. You might remember this logo from a long time ago. Yes, that is the Chinese coffee chain Luckin Coffee. So Duolingo crossed a significant milestone with over 50 million daily active users. The chess course emerged as the fastest growing subject. A major brand moment in Asia was achieved through a partnership with Luckin Coffee, resulting in over 10 million Duolingo branded drinks sold across 26,000 stores in 2 weeks. The company also launched a LinkedIn integration allowing learners to showcase their Duolingo scores. Okay, cute, but really not such a big deal. Strategically, Duolingo is shifting its investment balance towards longer-term initiatives, prioritizing user growth and teaching quality over immediate monetization in its A/B testing, driven by the conviction that AI can fundamentally transform education and lead to a much larger business in the long term. Of course, when you see and when you hear those changes, maybe the market is not that convinced, right? So when you put monetization at the second spot, maybe the market doesn't like that. But all in all, if you look at this, still very, very nice growing company. Look here at paid subscriber penetration as a percent of last 12 months monthly active users, went from 8.5% Q3 2024. We're now at 9%. All in all, nobody can tell me that this is a bad business. Okay, margin-wise, growth-wise, this is still a very good business. Now, looking ahead, and this is the problem, we always look ahead. Well, it's not the problem, but in this case, it explains why stock is down so much. So for the full year 2025, Duolingo has raised its bookings guidance slightly at the midpoint, expecting growth of 33% year over year or 32% on a constant currency basis. Revenue is anticipated to grow 38% year over year on both a reported and constant currency basis at the midpoint. The company expects its full year adjusted EBITDA margin guidance to be 29% at the midpoint, reflecting a 330 basis point expansion over the previous year. Gross margin for fiscal year 25 is projected to decline by approximately 80 basis points year over year, which is a 20 basis points improvement from the previous guidance due to lower than expected AI costs. Then for Q4, the adjusted EBITDA margin is guided to be 28% at the midpoint, factoring in continued investment in product-led AI initiatives in marketing. Now, if we quickly look at what they reported and what the market was expecting for the quarter, as you can see, beats across the board. The only small miss here is daily active users. And then for the outlook, sales, 275 million. Estimated number was 274 million, so a very, very small beat there. EBITDA is down by 4 million compared to the estimate number. And then this is, of course, the fiscal year revenue guidance. So the explanation, according to Brad here, stock market nerd, is this. Q4 bookings guidance was cut by 3.6%. They reiterated full year constant currency growth guidance, but cutting Q4 is the reason why the market basically reacts on this. Now, how do we know that this was cut? Basically, you get Q1, Q2, Q3, you get the full year, you can basically calculate it yourself. So again, this is a case of it's a good quarter, but it's not good enough, and guidance is definitely not good enough for now. Some changes in the future, prioritizing user growth, which again might be good because if you lock in users right now, you can try and monetize them further down the line. But I guess you will still have the AI is going to destroy this business, although it's been made quite clear that they are using AI to make this business better and better. I mean, nobody really likes to be down 22%, but being down 22% in just one day after the earnings report definitely hurts. The implied move was around 14%. Well, we're down way more than that. So we're back to prices not seen since August 2024, where this was, a support-ish area. But back then it was rebounding on that 200-day moving average. Right now we are clearly in no man's land. We are going to be oversold, of course, on the daily. I would be surprised if we're not oversold here on the weekly, although if you look at the weekly, we are going to be right on that 200-day moving average. Now, if you're going to ask me, are you going to add right now to Duolingo? My answer is no. I'm waiting. I am keeping my cash for the other companies, right? The Oscars, the Shiftforce, the Rubrik, and then next week we have Rocket Lab, we have Nebius as well, CoreWeave. I'm keeping the cash for those types of positions because, one, these companies don't have that many headwinds, in my opinion. They don't have that much pressure on their stock price. Yes, I am up on those positions. Well, Shift4 maybe not. But with Duolingo, I do feel like I have time. Yes, I will potentially add more in the future to reduce the average cost a little bit. But right now, like I said, I already over-invested, in my opinion, for such a position that I'm willing to take that hit for now, and then we'll see what happens moving forward. Again, I was completely wrong on the timing. You might say, yeah, but hindsight, no, not really, because I made it quite clear from a while ago, but fine. but I still believe this is a good business until proven otherwise. Quickly moving on to Elf Beauty. This is basically what has happened. Revenue did miss. Adjusted EPS is a beat. Adjusted EBITDA is a beat. Then as for guidance, misses across the board. Revenue, adjusted EPS, and adjusted EBITDA. As for the commentary, we gained 140 basis points of market share and saw a record launch of Rode in Sephora North America. We remain focused on share gains and the white space ahead. Looking at the stock right now, this one is also down around 22% after hours. It's now under the 200-day moving average on the weekly, and on the daily, well, about the same. About the same, also just under the 200-day moving average, which means we're going back to where we were 2 quarters ago. Moving on to DoorDash, we have a 14-cent miss here, EPS, but we do have a beat on revenue, marketplace GOV, and also total orders. As for guidance, this is basically it. We're still in the early stages. Strong demand, category expansion, and international scaling are driving momentum. Deliveroo is expected to contribute around $45 million to Q4 adjusted EBITDA and $200 million in 2026. If we look at DoorDash, it's also one of those businesses. Good business, growing quite quickly, top and bottom line, but not the cheapest one out there. Now it's experiencing a drawdown of around 24% from the peak, well, actually not that long ago, start of October, which we can see right here. It peaked at around $285. We're now at $214, and also here under the 200-day moving average. Stock is going to be oversold tomorrow. Moving on to Fortinet, we have a beat on revenue and beat on EPS for the quarter. Billings basically met, beat a tiny bit, but let's call it meet. Then as for fiscal year outlook, services revenue met, revenue, the same thing here. Adjusted EPS did beat, then adjusted gross margin between 80.3 to 80.8%. As for Q4, we have adjusted EPS that is a beat, and revenue is basically in line with expectations. Demand remains broad-based as customers adopt integrated networking plus security architectures. FortiSASE is scaling rapidly into the leading SaaS platform. Now, after the drawdown of around 12%, right now we're back to where we were 3 months ago. 3 months ago, the stock also crashed, so now we're having a drawdown since the start of the year of around 34%. This is one of those cybersecurity names that is not expensive. It's not expensive, has high margin, but it's not growing as fast as the others. That's for sure. It's not growing as fast as the others. All in all, I mean, the results, as we've seen, are okay. I guess the anticipation was much bigger than that, or at least a bit bigger than that. As for guidance, this is it. For the full year 2025, the company reaffirms its confidence in achieving Rule of 45 for the 6th consecutive year. So, yeah, I mean, it's one I get it's not great to own, right? You see the numbers, you see the margins, you see the price that you're paying for it compared to some of the other companies out there, especially in the cybersecurity space, and you're wondering, okay, what are we doing wrong here, right? Because literally, you're back to where we were 3 months ago. And it's not like it's been super expensive, priced to perfection or something like that. So quite strange here. Moving on to Figma. Stock is up a little bit, revenue beat, gap loss per share here, a miss, but that also includes a one-time IPO SBC charge. As for the rest here, this is basically it. We'll go and have a look at the report right now. Seems like a good one. Again, this is a company that is growing quite rapidly. Revenue $274 million, increased 38% year over year. Net dollar retention of 131%. Non-GAAP operating margin 12%. Adjusted free cash flow margin of 18%. Paid customers with over $10,000 in ARR sits at 12,910, and that's increasing 32%. Paid customers with over $100,000 in ARR increased 44% year over year. Remember, this is a company that went public not that long ago. For Q4, they project revenue to be between $292 million to $294 million. The full fiscal year revenue is estimated to be between $1.04 billion and $1.046 billion. So all in all, again, this is a company that is doing very well across the board. Growth rates are fine. I guess here as well, the question is, how much are you willing to pay for this company? Previously, we thought that $50 might have been the bottom. We did bounce all the way back to $70, then it went all the way down to now $45 or so. Could this be the bottom? Remains to be seen. Moving on to ARM. Now ARM, as you can clearly see here, beats across the board for this quarter and for next one as well. Not the biggest beats out there. This is also one of those expensive names, especially in the semiconductor industry or in this whole AI team, so to speak. But yeah, I mean, this is one that keeps performing, I guess, very well. If we go and have a look at especially one specific number that I'm interested in, and that's of course the RPO and how fast that is growing, or maybe how slow that is going, right? Because as I've said in the past, this is of course a very important company, but it's one where I just don't see the huge growth. So okay, annualized contract value, that has increased 28% year over year. Remaining performance obligations, as you can see, remaining performance obligations is not really growing that much. It's not really growing that much. So I'm always wondering why pay such a huge premium actually for ARM. Yes, again, great company, insane margins and all of that, but still it's $170 billion or so in market cap, not really generating that much revenue if you're asking me. Of course, huge margin, so okay, great. But still, you would have thought that RPO and this whole business would have grown much more. But okay, fine. Revenue increased 34% to $1.135 billion. Trailing 12 months non-GAAP free cash flow over $1 billion right now as well. So you can understand, right, the question. Super expensive, great performance, but yeah, it is what it is. Moving on to the last two, we have here Snap beats across the board for the quarter. Revenue increased 10%, adjusted EBITDA 38%, EPS on a GAAP basis up 33%, still a loss though. Daily active users up 8% and monthly active users up 7%, almost to a billion there. Q4 guidance, revenue basically met. Adjusted EBITDA was a beat. All in all, stock is up 14.6% or so. Okay, cool, cute, still under $10 right now. This is a trend that continues, right? This is great to see, up and to the right. If you look at the global daily active users, that increased 34 million or 8% year over year. This is basically the mix. North America has been flat and actually been losing a little bit. Rest of the world is increasing. Europe has increased a tiny bit. And as for revenue, yes, globally it's up 10%, 20% growth in Europe, 17% rest of the world. ARPU there is probably very, very low. North America only growing 5%, so not that great, I would say. And you can see that right here, right? ARPU in North America, much higher than in Europe and the rest of the world. They did announce a new $500 million share repurchase program, but as you can see over the past 4 quarters, they also lost around $500 million, so there is that. And so with Snap, because it was so beaten down, this is basically what you get right now. We're back above $8, back above the 100-day moving average. And lastly, we have Qualcomm. Qualcomm, as you can see, beat for this quarter, beat for a guidance Q1 their fiscal year. This is one of those semiconductor names where everything goes well for them. Stock price-wise, it's not really moving that much. It's actually down now 2.3%. It has been doing well over the last couple of weeks, I would say. But all in all, this is a company that is doing well. It's doing well revenue-wise. It's doing well EPS-wise. Valuation, it's really not that expensive. It's buying back shares. It's paying a dividend. So it's doing what it should be doing. Now, yes, maybe there are some segments of the business that potentially will be under pressure in the future, right? We've been talking about that, the Apple impact on the business and how big can they become in the laptop space and with their own solutions, capturing maybe market share from AMD and Intel, yes or no? The future of AR, VR glasses, Snapdragon, how powerful is that going to be in the future? I mean, okay, fine. But when you look at those numbers, when you look at the numbers right now, everything looks to be going in the right direction. Okay, it might not be growing as fast as an AMD or an NVIDIA or something like that, but it's also not priced as an NVIDIA or an AMD. So yeah, with Qualcomm, you have, I think, a solid company, solid stock, again, pays a dividend, buys back shares, but yeah, you're not getting, let's say, huge moves. Now you can see that the stock is basically at the same prices since November 2024, and actually also July 2024. Yes, at one point we went much higher here. I don't know what happened at the end of October, but we did get a huge move on the way up, and then while we closed down. So yes, we were lower, especially here in August at 145, went all the way to 200. We're now at $175. Qualcomm is a great company that's not expensive, and if they reach their, I think, long-term goals, it is looking quite cheap here. But then again, it has been looking quite cheap for quite a while, and as you can see over the past 5 years, stock has been underperforming. It's up only 20.7%. Over the past 3 years, it's up close to 60%, but still, for a name like this in that industry, you would have thought that it would be outperforming quite comfortably, but it isn't. And so all in all, that's about it. Of course, today was a much better day than Tuesday. We had Zeta that's up close to 20%. We have Iron up 15%, Micron up 9%, Applied Digital 6.4%, Marvell 6%, Nebius 5.8%, BMNR rebounding. So it was a pretty good day. Well, much better than the day before. We'll see what happens on Thursday and Friday. We'll see what happens with the government shutdown, at least at the time of recording this. I have no new news to tell about that, so we'll see what happens. I will come back tomorrow, talk about Oscar and Shift4, and maybe some other companies as well. So see you all in the next one. Bye-bye.